Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about a VanEck ETF later on, but for now, let's get into today's interview. Very pleased to welcome back to Forward Guidance Patrick Perret-Green of PPG Macro. Patrick works with some of the best and largest macro hedge funds in the world and has made some incredible calls over the past few years. Patrick, wonderful to see you. How you doing?
I'm great. It's great to be back with you, Jack.
What's on your mind?
I mean, the biggest thing is there's not really a clear narrative. I've been in this business far too long. As I was saying to you earlier, I started in classic timing 2 weeks before Black Monday. So people can look that up and then start to calculate how unfortunately old I am. We've got so many different conflicting forces at the moment. So we can talk about an ostensibly strong US economy that's still going. Is there inflation threats there? And then the other extreme, you've got what's going on in Asia. Okay, JGB yields are surging now. There's a few charts we can look at on that. I mean, certainly when you look on a shorter term chart, it looks like JGBs are driving other bond markets yields higher, and they are having an impact. However, if you look back on a 20-year chart, it looks like JGB yields are actually playing catch up. So maybe we should be cautious but not to be carried away. On the other side of the equation, we've clearly got a very deflationary China. And I still think that the world as a whole is not giving that enough credit in terms of the positive outlook for inflation.
Positive outlook for inflation, meaning lower inflation because that's good, or positive as in high inflation?
Lower inflation is good. I mean, China is the global producer. And we can look back at long-run charts of China producer prices. And it's very hard for other producers, certainly of manufactured goods, to break against that trend. And we see that China leads producer prices. It did it in the last decade. It did it. It was the first to see producer prices really come tumbling down. Obviously, they didn't get hit to the same degree by the Ukraine war and energy prices because they're getting cheap energy from Russia. But overall, and then we've got the other side of it, of the ongoing property bust, which, for my mind, is it could almost become a generational issue when you add in not only excess supply but demographics. The inability of the Chinese state to enthuse consumers. Whereas in the past, if you go back to 2015, big stimulus, get the housing market going again. This time around, debt metrics and the sheer scale of the problems mean that's very difficult. And we're seeing that despite all the news and all the excitement that people have had recently, which is also being a big factor behind the rise in Chinese equity since February. The reality is that people's hands are still staying in their pockets, and that while there might be a small uptick in housing activity, if you look at residential, just the latest data for the tier 1 cities, which are actually doing better, floor space sales are down at historic lows. You've got to go, and if you do national levels, they're back to level of sales is back to sort of, you've got to go back 15 years or so, just with, and that's with, consider that's the site where the economy was so much smaller then. And there are some very powerful deflationary impacts. So we can look at what households are doing. We've seen household borrowing has slowed to a snail's pace, and basically household deposits have absolutely surged. So one of the ways I look at it is the equivalent of a loan deposit ratio of household loan deposits. And it's had a dramatic fall. So early 21, it's about 70%. Now we're down about 56%. It says you're not getting rid of the debt. Obviously, some people are, but overall, that's an effective deleverage. It means money supply growth has slowed to historic lows. But not only that, the velocity of money is slowed to historic lows. So if you follow a Lacey Hunt school of thought, that's very deflationary, and we've seen it in other busts. You can talk about the post-GFC era, that overall consumer saver behavior operates like a super tanker. It's hard to see anything rebounding very soon. So China domestic demand is going to remain soft. How Chinese exports do going forward is with more sort of trade arguments, let's put that politely, and a sheer excess capacity there. It just says to me that it's going to be a very deflationary force. And it's interesting. So I think, we talk about commodities, and it does seem to me, and there's sort of a bit of froth going on. So China is, for example, China is the world's biggest consumer of copper. It takes 50%, over half of the world's copper, of which the real estate industry took about 50% of that. Mostly, and you divide it up, it's about 70% of that would go into power lines and transmission, etc., and the other bit would go into buildings. You've got housing starts down by 50%. So that's, 50% of 30 or so 7.5% of global copper demand isn't there anymore. It's disappearing.
And yet the price of copper is at all-time highs.
Yeah, so there's a lot of speculation. To my mind, there's a lot of speculation going on there. So we're seeing inventories in China, copper and iron ore rise. And some people say, oh, they're stock panics, they're afraid of inflation and all this sort of stuff. Well, no, actually, I prefer to look at the iron ore side of things and the steel industry. And what China's doing is exports. And also, Chinese copper is trading at a discount. So normally when demand is high in China for it, really, there's a premium, and that's not. So we're going to talk about the EVs and the green generation and all this sort of stuff, but the real substantive demand, to my mind, remains weak. So I'm very cautious about this sort of commodities frenzy that's going on, and you can take that. Well, you say the same about AI, and all of a sudden everyone loves utilities because AI is so energy intensive. That it also raises the question of just how many of these AI businesses or anything AI related is actually economically feasible if they need so much energy. Is it going to be like a railway boom or stuff like that, or airline booms? You can talk about all these various past historic where you get a vast influx of capital. So we could talk about NVIDIA, although there's a lot of stuff talking about the way that NVIDIA books its revenues and it's sort of I'll leave it to others, but there's plenty of stuff there out on Twitter, and I will continue to call it Twitter. I'm never going to call it give it the X word. I mean, it's just no one talks about it. Oh, I X someone. Yeah, well, that normally, no. So I think China remains an economic problem.
Patrick, before we go to geopolitics, so China is a deflationary force, and deflation is prices going down, and that could, if it exports that deflation around the world, that could moderate inflation around the world in the US and Europe, so call it disinflation, help inflation return to the Fed's 2% mandate. We see that today, for example, BYD, the Chinese largest electrical vehicle manufacturer, making a 5th generation hybrid that's under $14,000. So definitely very cheap. So what do you think the impact of Chinese deflation will be on the rest of the world? Do you think it could cause a global slowdown? For example, if the US has a slowdown because the US consumes so many things, the saying is, if the US catches a cold, the rest of the world catches a flu or something.
I think there's a broader issue there. Is one we're seeing, for example, already what's going on in autos. So the great auto shortage is dead. We could see that from inventory numbers. Okay, there are certain brands, and who's the guy who's done all the stuff? Car dealership guy who's just like become this brand in next to no time because he produces such great stuff. But so there's still demand for your Toyotas and things like that. But if you want an F-150 or stuff like, or big truck, the inventories are way up now. And also what we're seeing is, I saw something else earlier on today that Buick are bringing out a new car, and it's like the prices are really coming down as well. So, and the discounts, we can see the incentives. All of a sudden, we're back to 0 interest rates for 72 months, and the incentives are really massive, which is an interesting one because I'm trying to figure out, just as off the top of my head, when the BLS talks about new car prices, how much does it factor in the incentives, or it's just taking list prices or stuff like that? But that's a minor little thing in terms of, I think goods price inflation is going to remain soft overall, and you've just got to compete, haven't you? I mean, you have to take the margin pressure. And we've said, I suppose on the other side of it, we have seen a concentration of powers in industries. You can talk about it in tech, you can talk about it in food manufacturing, you can talk about it in shipping, where I personally feel like all the global shipping lines should be taken to, but they've got various exemptions because of their weird status. So I mean, when Maersk, you could say, cost pressures are greater, but Maersk made $15 billion in 1 year, which was like 15 years of profit. And there's a lot of stuff, if you follow freight waves or the Lodestar at the moment, where it seems like, okay, there are disruptions at the moment. And there seems to be people are bringing forward, normally the seasonal demand gets really strong about July, and people are bringing forward that demand because they're concerned about inventories, even though many inventories, if you look at the broader merchant wholesaler inventories versus sales ratios, they're still pretty high. And actually, the top end of their ranges by historical standards. But in terms of what has been the marginal source of demand for inflation, you probably say the U.S. consumer, because he's had his the huge fiscal stimulus and the long-running effect of the CARES Act, which most people don't tend to realize that a lot of that lasted until very recently, be it money that went to state and local governments, you've got to spend it, or healthcare subsidies, and the number of people who are now, how enrollments are falling off Medicaid because those freebies are disappearing.
But Patrick, you're sure about that? Because you and I have both heard that as early as 2021, that the fiscal stimulus was fading away, and it did. I mean, people were no longer getting checks in the mail.
No, but there was the underlying other elements of the CARES which had lasted up until now. They lasted for like 3 years, and they are like they're dead. They're finished. They're ending. They've ended effectively. So we are going into a tighter fiscal environment, and also it looks like it's very clear that we're seeing it from the certainly middle to lower incomes. Definitely now starting to struggle. I mean, you could see that from the surge in delinquencies, that a lot of people, because their income went up and they were having like moratoriums on, well, you couldn't get evicted, or you were having a student loan moratorium and all sorts of stuff. Your credit score went up, they borrowed more, and then classically they're going bust. And when we look at the pace of the delinquencies, the surge we're seeing, it's becoming almost exponential, and don't forget, this is against a background of supposedly good employment. And there's a whole debate out there as well. So how strong is the US labor market really? There's a lot of problems with the data, a lot of questions about the data. I mean, up until, I think through my career, and we've generally taken BLS employment numbers at face value. And then how can we get all of a sudden, you have other guests on here like Danielle, the Martino booth, and we've all talked about, well, we get these final revisions for the third quarter of last year, and the BLS says, oh, well, non-farm payroll data, you look at Bloomberg, even now, the non-farm payroll data for Q3 shows 561,000 jobs created, and the BLS comes out and said, well, actually, we think we lost 192,000 jobs. And are we going to get these revisions going backwards? So we've obviously had these very, very strong employment numbers at the start of this year. And it does leave everyone scratching. But also it's the quality of employment that's going on. So we're now at levels, when you look at it, and you can do like simple ratios, for example, of the percentage of jobs being created that are government and healthcare. And we're now back, they're about 60% of jobs. And you go back at the history, you look back at the data that we had, when you look at those data series, and that's what we saw going into 2007, 2008. It's what we saw into 2001. So, it's a qualitative element. So, high-paying jobs, and Bloomberg actually has a series for high-paying jobs where you take it and you look at that employment creation of better-paying jobs has virtually ground to a halt. So lower incomes are increasingly stretched and strained. Credit standards are still tightening. If anything, more interest rates on things like credit cards, and they have been the reals. When we look at consumer loans, they've been the driving rise in consumer loans over recent times. So they're now like 55% of consumer loans, over 55%, which is the highest level since
credit cards as a percentage of consumer loans.
Yeah, within the commercial banking system. And commercial banks are actually retreating quite rapidly on auto lending and stuff like that.
Yes.
They're being very cautious about that sort of things. And we've actually seen consumer growth. So we had a surge of confidence, everyone coming out from consuming. Also, their debt balance had fallen down. So they thought, I've got space to spend. And a very strong employment market. And now we're seeing the rate of consumer borrowing or bank borrowing is down to, over the past 3 and 6 months, it's virtually zero. And the year-on-year rate is down to less than 3%, which is historically low. It never grew that slowly in the last decade. So we're seeing a thing that consumers are sort of getting tapped out on their credit cards or on their ability to borrow, and lenders have been more cautious. How is that going to impact overall consumption going forward? And then even on the anecdotal stuff, we're seeing Target coming out and saying that they were seeing people even reducing spending on essentials. So it's like, no, right, I'm going to start counting out the pieces of paper that before you go to the bathroom. We're going to hit rationing. And we get, but you know what I mean? It's that sort of element. So people go, oh yeah, but they don't, it's the wealthy who are responsible for bulk of consumer spending. Yes, they are. They always are. But it's the cracks at the edges. Ultimately, when we talk about economies that with growth of 2%, well, if a big enough proportion of people, even on low incomes, start to suffer, unemployment starts to rise, and there's that. So we look at all the arguments going on about the rise in unemployment in various states, things like U6, the Kansas Fed's labor market conditions index has really started to deteriorate quite rapidly, and it tends to lead the way. U6 has risen more than U3, so that's the people who are marginally attached to the labor force, and they always tend to be the ones who lose their jobs first. So there are these cracks out there. Yes, inflation has been sticky, but the question is how sticky it will be going forward. Yes, because of the surge of inflation we saw in 21, 22. Obviously, there's a large amount of wage catch-up, but then we look at, and it doesn't matter if it's the US or the UK or Europe. If you look at and it was notable, I found, that Powell, in the press conference, he actually talked about the Indeed labour market. Normally, very rare for a Fed chair to actually talk about a non-official data series. And we look at the wage growth on those.
Sorry, which data series did he talk about?
Well, it's like the Indeed, so the biggest private, but they're Indeed hiring lab, and people can find that. Just Google Indeed hiring lab, and it's all out there. But you can see the rates of pay are now, according to Indeed, all down to around about 3% in the UK, or pretty much 3% everywhere. So that says that what we're seeing in wage data is certainly in Europe and the UK, which were worse hit by the Ukraine crisis. So we obviously got, because of energy, we got a bigger hit. But that's all very encouraging. And I think when it comes to central banks, my general view is that when we look at what central banks were thinking in the middle of last year, when they were doing their let's call it the last 50 or 75 basis points of hikes, and their inflation forecasts were much more negative as a whole, well, much higher than reality has proved to be. Well, if you think about, for example, the ECB and the Bank of England, when they were hiking rates, ECB last hike was in September, which is completely unnecessary. And the UK, I think it was August. But even the mid-year hikes, were they really necessary? Because they were based on inflation forecasts that have proved to be way too high. So effectively, the real interest rates they were thinking they would have had are actually much greater than they are now. So they over-tighten because they're scarred by their experience. I think they're looking in the rearview mirror. So they will become data independent rather than forward-looking, which is, well, we were always told that central bankers were meant to be forward-looking because of the lags of monetary policy. Now, it's basically, they're like a racetrack driver. They're just going down the road and they're looking ahead of themselves. And if they're thinking, oh, wow, suddenly they're going to have to do a sharp U-turn or a right turn and go into, because they're handicapped.
Forward Guidance is brought to you by VanEck. The VanEck Morningstar Wide Moat ETF, ticker MOAT, has outperformed the S&P 500 for over a decade. How? Moat strives to achieve a simple but challenging task: buy quality stocks when they're undervalued and sell them when they're overvalued. Visit vaneck.com/moatfg to learn more. That's vaneck.com/moatfg. Now the disclosures. All investing is subject to risk, including the possible loss of money you invest. Visit vaneck.com to carefully read a prospectus before investing. The VanEck Morningstar-wide Moat ETF is distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks. Let's get back to the interview. Yeah, Patrick, I agree with you that central bankers now are definitely trying to be forward-looking, but they are data-dependent, looking on the past, and they don't want to make the mistake of acting too quickly. I would dispute, though, that there's some golden area of the past where central bankers would always act, with the future in mind. You think of Jean-Claude Trichet's hike in the app
in 2008,
yeah, exactly, in 2008
and in 2011.
Yes. So we saw that in the Federal Reserve in the US, that as inflation fell last year, the real, i.e. inflation adjusted rate of interest increased, so that central bankers saw that as inflation falls, keeping the nominal rate level at 5.3%, let's say in the US, the real rate of interest rises, i.e. becomes more restrictive. So then it causes a need to cut. And that's why the Fed penciled in 3 dot plots this year.
Yeah. I mean, I think that's reasonable, but now we've got a market that's given. I was thinking myself, so is the squid a good economic reverse indicator? So at the start of the year, Goldman, it was all in the press, so it was all like Goldman's produced. 15th of January, I checked it today. Goldman's were predicting that there were going to be 5 rate cuts this year. 4 months on, they're now saying we're only having 2, and the market was pricing 5. Got to that point. Now it's pricing in virtually only a bit more than 1. I think we're down to 31 basis points price for the rest of this year, which again, just on a purely sort of cynical reversal basis. So, and then, when we look at things like money growth, yes, M2 has ticked up marginally year on year, but it's only up like 0.6%. It's basically gone sideways last year. Real M2 obviously is still contracting, and that's a rare event. So the monetary aggregates say that the outlook for inflation is reasonably constructive. And I think it's a normalization as well. I was talking to someone, last week, and we were just saying, sort of, the revenge spend is over. After COVID, we all felt, I deserve it. I'm worth it. We're all like L'Oreal adverts. And now it's like, it's a fading memory, and we are normalizing. We're going back. And then there's other factors as well. If the downturns, we're talking about unemployment. We're also talking about background, particularly in the States, where, you can argue that because of equities and stuff like that, savings ratios, what is the savings ratio? Is it the amount of money that people are saving in their savings account every month? But if they feel like the net worth has gone up and the pension fund's gone up, the 401k's gone up in value, they can argue that my savings are adequate. But overall, another risk consumption is that savings ratios normalize. And if the economy does start to slow down, actually what happens is the savings ratio rises and consumption gets a further knock. There's another whole concept about ZERP. When we're seeing it, I think it's playing a role in China at the moment, that as interest rates go lower, people save more. So that's another risk down the line that should, when we talk about things, if savings ratios normalizes, and it's very much a US phenomenon. It's not a UK phenomenon. Savings have actually remained quite high in the US.
So ZERP is zero interest rate policy. Interest rates in China are not at zero, but they are very low. And the idea is when central banks cut rates, it's because the economy is weak, and cutting interest rates is not often or sometimes a sufficient incentive for people to get money out of cash and put it into the economy, or by investing or spending. Sometimes they just keep the money there. But I got to challenge you, Patrick. I've reinvented myself as a tough interviewer. Personal consumption expenditures in the U.S., has grown 5.8% year over year. So in 2022, when everyone was worried about a recession, myself included, it's kind of amazing that personal spending in the U.S., consumption expenditures, was up 12%, 10%, and now it's only up 5.8%, let's say 6%.
No, it depends. If you're talking about the GDP data, it's certainly not up that much.
No, but I'm talking about PCE, personal consumption expense, like not the price index, but just the.
No, we get the latest data out later on this week, don't we? So I'll look it up in a second. Hang on.
March 2024 versus March 2023 was up 5.84%. In January, it was up only 4.41%. But again, that suggests a reacceleration.
Oh, yeah. Nominal dollars, 5.8. There we go. So, yes, personal consumptions is being remarkably strong. Although when we look at, but that's, where were we in December of 2019? We were at 4.9. Let's see how that goes going forward, because retail sales are tending to soften up. So we'll see how that comes out. But again, that's my point. If as consumer confidence, so everyone goes, consumer confidence rose yesterday. Hang on, look at the chart. It's a noisy series, but it's still down at its lows. So a little back, it's noise.
And again, consumer confidence was incredibly low in 2022 when people were spending money by 10 to 12%. So I don't trust these emotional surveys. Not that I put too much stock in the data, but the data is better than the.
No, we're all scarred by COVID as well. I mean, everyone's like, oh, yeah, I'm still chicken little, really.
I mean, like half of Americans think the stock market is down this year. So.
Unemployment is surged and inflation is running at 10%. I know. I mean, I think Europe and the UK are in a different space. We're sort of, it feels like we're adjusting. So we talk about relative performance. So kind of thing. On an economic surprise basis, people go, Euro PMIs are going back towards 50, but let's not forget the nature of PMIs, but they're inherently binary. It's, are things getting worse or are they getting better? Or are they unchanged? So you could be down at 40, you could be in a hole, are things getting any better? No, they're the same. So therefore you got to go up to 50. So we have to keep a context. And I think, there's far too much noise and excitement about data as a whole. More broadly, I think that we're seeing my sort of broader view is we're probably going back to a bit more of the sort of pre-COVID environment that we grind along. Governments are even more fiscally restricted because of the rise in debt from the whole experience of the pandemic. Consumers as a whole, well, in Europe and the UK, consumer saving remains high. And I don't think we're really going to tap our savings. So it's sort of, that adds the sort of, I'm more relaxed about inflation. I think that central bankers can ease. I'm not talking about massive easing, but taking rates 100 basis points lower in a relatively short space of time, I don't think would be particularly inflationary. I think it would actually, for example, in the UK, we see lots of signs of business stress with there's an accountancy firm called Begneys Trader, but they're like the UK liquidation specialists, and they come out with a quarterly report, their red alert report, and the last one said that with 555,000 businesses in the UK were in severe financial difficulties. I mean, for a relatively small country, that's a lot of businesses that are struggling.
Patrick, can I ask you a question? I'm just looking at the UK unemployment rate. So you said you entered the business 2 weeks before 1987. Isn't it true that the unemployment rate at 4.3% is lower than any time in your career?
Well, no, it has been lower before. We're down to 3.
Like 6 months ago. So it went from 3.9 to 4.3. But
yeah, we've had some noise with the unemployment data, but in the UK, but overall, but it does feel what we're seeing, and it's not just the UK. I mean, a lot of stuff you talk about. What's happening in California, this minimum wage for fast food workers of $20 a week. But what's happening is, they may be getting their $20 an hour. They may be getting their $20 an hour.
Did you say $20 a week?
No, I said $20 an hour. I meant $20 an hour.
That would be pretty deflationary, I would have to say.
No, but what I'm saying is they've done that. But what's happening is you actually get a reduction in hours. And that's the other side of things. So income growth. So we talk about average hourly earnings and how they're coming down. But when you look at aggregate earnings, So what's happened to the work week and overtime, then actually that's actually negating a lot of the increase in pay. So the sort of the average weekly earning, average weekly pay packet isn't rising as much as the average hourly earnings because you're doing less hours. So there's all these little things around the edges. So I'm sort of fairly relaxed about things. Obviously, we've got an election coming up in the States. We've got an election coming in the UK in 6 weeks' time.
Who do you think's going to win?
Well, Labour in the UK, Labour are so far ahead of the polls. So we tend to do this whenever the Tories have been in office for a long period of time. There's always it's time for a change element. So it'll be remarkable if Labour don't win an overall majority. But at the same time, they're so fiscally constrained, and they're basically saying, well, we're not going to raise taxes, and we're not going to do this, we're not going to do that. Is there really going to be that much change? There'll be some tinkering around the edges. But overall, I look back and I think the last Labour government under Tony Blair was more conservative than the previous Conservative government in terms of its economic policies. I just think it's like rates should come down a bit. I'm not too worried about global inflation. I do remain concerned about China, and it's also interesting over the past few weeks. So I've had a basic line from an FX perspective that China is effectively pegging itself to the dollar. So if the dollar comes off, China would just go with the dollar, and they were quite happy. But we've seen this just over the past few weeks. So we've seen the dollar starts to fall. So the euro is stronger, the pound is stronger. Go about yen, but despite that, dollar CNH, dollar CNY has actually weakened, and the Chinese allow it to weaken. It's like just gradually, and that's another issue. So what happened? So basically, monetary policy in China is down. Is sort of down. Rates are down to levels where they really going to struggle to push them much lower. So you've got a 2-year Chinese government bond is hit actually outside of the COVID had a draft down during the lockdown in China in 2020. But the 2-year yield below 180 today. You have to really go back to GFC times to have the 2-year rate lower. 10-year bond yields are effectively at their lows, like 230. That's a historic low. The 30-year bond in China is at 2.5. And the monetary policy is putting out a strain. So actually, if we've got excess capacity, the exchange rate becomes the only other real form of, they're limited on the fiscal side because their overall government deficit is so large. When we talk about, everyone here says the federal deficit is not that big, but then you've got all the other public sector deficits. So monetary policy, the exchange rate is another form. We can argue about valuations and stuff like that, but it's very clear. And you can see people like Brad Setzer, the CFR, writes a lot about China, put some very good stuff out on Twitter. That's why that's one little thing I just want to mention. We're all trying to do our thing. We're all trying to work out what to do next, advise our clients. But everyone talks about Twitter being such a toxic place, but I'd actually say within the FinTwit community, there's a remarkable generosity of spirit as a whole. People are happy to share ideas. And so I'm more than happy to name check people and say, because it's like, they know much. There's plenty of people who know lots more than me. I'm sort of quite good at putting lots of different things together. But, there's some people who really know their stuff about, specific experts in specific areas. So I'm a complete vulture when I go around looking at stuff. Oh, that's interesting. And it adds to the narrative. And I think it's, trying to shape a narrative. Where are we? Where are we going to be? I struggle with reflation when we got monetary aggregates coming down and consumers getting stretched and labour markets overall loosening. And people go about job openings, but I look at the job openings, and I'll put that chart on. When we look at the job openings, and that's another one, it's a classic why we should question the BLS.
On China, why is there a government budget deficit, i.e. Chinese government is spending more money than it taxes, if China runs a huge trade surplus with the rest of the world? I thought they had to balance.
The budget deficit is purely from domestic fiscal expenditures and revenues. So if incomes are growing, employment's weak, income growth is low. They're still spending huge amounts on defense, and diverting, trying to deal with local governments, etc. They still provide most of the fund. Local governments are struggling. Local governments have traditionally relied on land sales as a significant portion of revenue, and obviously land sales have fallen off a cliff. So a lot of domestic, and also they're not getting the same revenues. So we talk about industrial, but in manufacturing maybe they're okay, but industrial profits are up slightly. But the service sector as a whole in China is still struggling greatly. So we could see, they're traveling more internally.
Yes,
but the spend is down. So they're budget tourists now. So there's a huge amount of caution amongst Chinese, but the surplus is big, partly because Chinese import demand is so soft, but also they are producing. We just have to look at steel exports, and steel exports have surged. So China's now exporting something like 8-9 million tons a month. It's just dumping it on the world. So what do? How do we make life more painful for other people? Actually, we can let the currency go a little bit, and they can turn around and quite justifiably say, "Hey, you don't mind about the yen, do you? This is we're being free markets. If it can boost domestic inflation and maybe encourage people to spend a bit more, and boost Chinese exports, and in turn, it will make life much harder for its international competitors." And we just have to look at what's happening in the automotive industry. The capacity in China for automotive production is enormous. The exports have surged. They're the biggest auto exporters in the world. So that's just invading everybody else's territory as well.
And sorry, Patrick, I realized you kind of answered my own question. The surplus is had by the Chinese citizenry, the private sector, who have an enormous amount. The savings rate in China is incredibly high, and that is allowing the rest of the world to run a trade deficit with China and the Chinese government to run a trade deficit with them. So the Chinese private sector is running a huge surplus. The only issue is they're not spending the money, and that has its own economic.
Well, you can think about Michael Pettis is the main. Yep. He's argued for years about the need to rebalance the economy. We've heard, I can think like past 15 years, China's been talking about rebalancing the economy, and it never has. If they, one of the things to do, and this is exactly what they did in 2015. Let's not forget. They got to a point where they felt, okay, also it's the FX flow. So we can talk about this great surplus, but then the money seems to be leaking out, and Chinese banks are holding money. They're not. So they make exports and they get paid in dollars. The money's staying in that dollar account. It's not getting repatriated back into CNY within China, or a lot of that money. I don't think we see a dramatic devaluation, but after we've seen dollar CNH back at 7.35 previous, not that long ago, but just drifting up. But then the question is, what does it do to all the other currencies? So when we look at China against the euro, which obviously is one of its biggest, Eurozone is its biggest export competitor, really, or what are the implications of that for the Aussie dollar and the Kiwi dollar? They seem to be pretty negative.
And so Patrick, the Chinese yuan was actually pegged until 2005, and then it's been an informal linking to a basket of currencies where it's supposed to be within.
More like 2008, really, and then and then they started to move, and we had CNH was introduced in 2010. That's when I went. I went to Asia to work on the opening of CNH, and
renminbi is like money in China. Chinese yuan, CNY, Chinese yuan. CNH is offshore Chinese yuan, right?
Yeah, and that's the one that. Obviously they trade in it's a very tight gap, but it's the real transactions, I suppose, are underlying are done in CNY. But overall, if the currency goes, so we go back to where we started with like the original risk. If China actually goes back and lets the currency go, that's another disinflationary. It adds to the disinflationary force.
Yes.
And then if China starts to reflate, well, then that actually will add to global inflation, but it takes a lot of time. I mean, back in between 2012 and 2016, we saw China producer prices were down year on year for 54 months in a row. And the difference is now what we're seeing in China is that we're also seeing house prices falling for really since for 20 odd months in a row. So just looking at the back calculated. So house prices are down from, I think, beginning of 2022 by about 12% overall. So that's another element that's there that reinforces caution, given that property is the biggest store of household wealth. So if your portfolio is shrinking, you've got to save more money. So how are you going to reinvigorate the Chinese consumer? And I think I just don't see it happening for a considerable period of time. Does that mean that geopolitics is a risk? China can't afford to go to war. I mean, it could if it thinks, there's always that nationalistic element. But given, we all talk about, China's doing much more trade with Russia, but I think its exports to Russia last year were something like $240 billion. Whereas we look at Chinese exports in a single month, and they're the order of, $500 billion? I mean, China needs the rest of the world as well. Without the rest of the world and that external demand, Chinese economy gets even worse. So, I mean, that's the plus side from a political perspective.
Patrick, don't you think I know you're a student of history, military history, as well as financial history. Aren't wars not constrained by financial elements? The war can only last 6 months because we'll run out of money. They find the money. They print it.
Oh, they always find the money.
They stimulate, if they're a huge exporter and there's a trade embargo, the exporters suddenly produce domestic weapons for the national military. World War I, World War II.
Yeah, I mean, you could argue
huge debt increase, and actually there's a connection between wars and central banks. Not that central banks create wars, but that wars create central banks because there's a huge amount of debt, and then they have to be.
Well, that was the original rationale behind the founding of the Bank of England back in the 1600s.
Yeah, and the first and second bank of the U.S.
So to borrow money, create the gilt market. So I mean, ultimately, but I suppose from the other side, we didn't have countries were largely, UK may have been a big trading, but countries were largely self-contained then. We didn't import strawberries in December, but we just ate them when they were available seasonally. The world's a mess, we know that, and I think I think a lot more can we do. But I'm not going to get into a geopolitical argument.
Yeah,
because just makes so many other people angry. I mean, that's ads. It is underlying it. You could argue it's an underlying inflation, and it's not what we've had in the previous decade. So, in fact, wars are inherently inflationary. Yes. So maybe that keeps it up. I mean, it's the whole demographic debate. So you've got the good heart line of things that aging populations are like to boost inflation, and then we have the reality of Japan, where an aging population has done exactly the opposite. And you could argue maybe that's the same in China as well. So, yes, you need more care home givers and health workers.
And fewer workers to do it.
But at the same time, the marginal propensity of consumer of old people, apart from purchasing medicines and healthcare, drops. I mean, you get to your grandparents' house and that's the last sofa they're ever going to have.
Yeah.
They'll make things last. It's that sort of mentality. So
they're not trying to get the latest fashions, No,
that TV works fine. But what I'm saying is it's a challenging environment. I think it is a challenging environment. And one of the things we try and do is we talk about the sort of what ifs. I mean, just try and prepare for things. So a lot of the time it can be very boring. It's like all quiet on the Western Front. You're sitting around and you're going like, particularly when interest rate cycles are at their peak. So you often get things, it seems noisy, but actually you're just going, this is a bit of a Z. 10-year notes were at 470 not that long ago. We went down to 430. We're now back at 4.5 or a bit more, but 455. But overall, certainly for the investor player, it's basically a big picture guy. So if I talk to a big asset manager and he's going, well, I can buy these long-term bonds. And right away, people look at them as like on the forward implied yield basis. So, 10-year implied yields. And they're still talking about big liabilities. Another big one for Japan. Yes, they can tighten monetary policy, but there's another risk out there. And it's interesting if you look back, the Nikkei actually peaked in March, and it's off like 2,000 points from its high or more, 2,500. I can't remember. I was looking at it earlier on this morning. But you also got, within Japan itself, you've got the GPIF, which has had this huge pension scheme that's over the past decade has diverted money to equities and overseas assets. But given the rise in Japanese yields now, so we now got 30-year yields at like 2.25, 40-year yields at 260. At some point, or the implied, when you look at these implied yields, and I know it's a bit of a theoretical context for a lot of people, but like a 15-year implied rate is now over 3%.
Yeah, so that's what the 15-year yield is going to be in 15 years. And like this is not correct, but it's just take the 30-year yield and then subtract
effectively the 15-year yield, and do the maths. But that's a rough. But my point being is, if you're a liability manager, then you end actually going out and saying, well, actually, given we've had our stocks, we've had this huge rally in the stocks, and therefore what we should do is lock into the bonds. So could we get to a point? So one of the things we're trying to do is, it's not now, but it's basically like war gaming. Try and think of what happens if something happens. I used to go to my graduates, the new analysts coming in. I like Muggins was the one, because my boss couldn't be bothered by it. But so I deal with the newbies coming onto the trading floor, trying to teach them about stuff. And I tell them, come out with questions. Well, what would you do if you heard that? When we talk about massive earthquake in California, well, I saw one of those. I think it was the one in '96. We obviously had the Kobe earthquake in Japan, had the tsunami in 2011, and you go like, okay, what would you do if first commercial, successful commercial test the fusion reactor? What does that do to oil? What does that do for everything? Little questions like that. How to think about things. So one would be, well, what happens if we suddenly say, well, actually, the GPIF in Japan has decided it's going to do an allocation switch. It's going to reweight its portfolio. Or the Bank of Japan, for example, is sitting on vast profits from its ETF holdings. Does it start to actually sell off those ETF because there is so much in the money? And actually, could that money then go, does it get repaid to the government? Does it help reduce the national debt? All these multiple little issues. But then you think, well, if Bank of Japan becomes a seller of equities, what does that do for equity prices as a whole? So you don't know necessarily the answers, but it's like, what, so going back to the US, what are you going to do if we see there's lots of data series that suggest that, be it ISM, both their employment or the other regional Fed employment levels, are all saying that historically at these sort of measurements, we'd be seeing negative payroll numbers.
What are you seeing that would make you say you'd see negative payroll numbers?
Well, you can look around it. You can just look back at, if you mine just do simple data. I'm crap at modeling and stuff like that. I'll leave that to the math ski. But, you just look back, and over time, if ISM or ISM is at employment is at 45 or 47, that's normally consistent with non-farm payrolls coming at, 0 to minus 50 a month.
You're talking about PMIs.
PMIs, yeah.
Patrick,
National Association of Purchasing Managers.
Has there been a economic indicator that has lost people more money than looking at PPIs? Because PPIs were declining from 60 to 55 as early as late 2021, I think. And that had all the macro boys going out saying, well, back on base, and they were the modelers, fortunately not you. I mean, you were on the short race trade, and I know that, just to be clear. But they were saying, oh, the last time, anytime the PMI goes from 60 to 55, or anytime it declines, basically, bonds do well. That's what my back test says. And that trade has just been running off a cliff because the economy was so hot in nominal growth in 2021 that to slow from 12% to 6% is not a recession. And it's not a time to buy bonds, especially when they start at 1%.
I think this is what come back to the pandemic, and I was talking about the pandemic experience. And I think, it was such a curveball that it basically meant, economists sit there and they've got all their models and their seasonal adjustments. Well, seasonal adjustments just go out the window in the pandemic. They're irrelevant because there was no season up now. Everything. What it does feel now is we are getting back as a whole. We're talking about you go to the pandemic, and then the war in Ukraine, and really that's 2020 up until, for example, in the energy disruption, we only really started seeing that energy disruption start to fall out in the latter part of last year in the UK in terms of our energy bills. So effectively, we're talking about the best part of 4 years has been completely chaotic and has chopped up, when I think, for example, the Office of National Statistics, I think, is one of the best statistical bodies globally, much better than the US. Its resources are much better. We have a digitalized tax system that, whereas everything in the US is positively antediluvian when it comes to unemployment and state data and local governments and gathering of data. I was going to talk about the BLS. Talk about the BLS. So everyone goes about job offerings. You dig down into that, okay, they only survey 21,500 institutions, and the response rate has dropped to about 32%. So you're basically saying 7,500 institutions are applying to this survey. And we've got some really weird stuff that small businesses, so this is businesses with less than 10 employees, now account for a record proportion of job openings. Well, how does that work out when we look at things like the National Federation of Independent Business surveys that come out with their monthly data, and they go, hiring plans are down to the lowest level since about 2016. It's like, or you get paychecks, which do the small business wages and job index, which is also at the weakest level, pretty much in it's only a limited history since about 2016 or 17. So actually it's its softest level. So, I think the JOLTS data is a joke. To be honest, when you actually look at, if you look at bigger listed companies, you take out those tiny businesses, so companies with more than 10 employees, job offerings are back to where they were in 2018. So there's an illusion, and that fits more again with the stuff that we get from the employment companies like Indeed or other surveys that suggest that the employment market is not as strong. And so, my question is, as federal spend fades and state spend fades, the shock number will be, for me, is going to be the negative payroll number. And that could come in next 3 to 6 months. So, Danielle's, I talked about Danielle earlier on. She's talked a lot about employment data and the SARN rule versus the McKelvey rule and all these measures being made. So if the data, my gut feel, and I suppose it has to, ultimately this course comes down to it, my gut feel is that we're getting back to a point where the data is actually settling down, so we can start to go back to thinking of it more in a broader historical context that we've been sort of looking at in the past 35, 40 years plus, when we run those big long data series. And so a lot of the time when I'm looking at data now, I actually deliberately exclude 2020 through to 2023. And I'll look back from, maybe 1980 to the end of 1919. 2019 rather, 1919. To look at those patterns. And if we're going back to those relationships, where are you going to be? And they all say, well, actually, we should probably be having a negative payroll. at some point, and then what happens? And then so that brings me back then to again, it's Powell's words that, sort of an unexpected weakening of the labor market, and he's already told us what will make the Fed change policy. So when we're at a point now, from a rates perspective, certainly in the front end pricing, from a rates perspective, if a 2-year, personally, I'm quite happy to own a 2-year note of 5%.
On a levered basis, when you're borrowing at 5.3%, are you?
Well, no, I mean, I talk about P, just from an investment perspective. And I mean, I suppose if I was, I'd rather have that element. And then, but again, it's being prepped for it. It's having that idea that what do we do if we hear in hay rolls? Well, yeah, you buy bonds, but then you keep buying them. It's having that game plan. It's working out what you're going to do next and what are the implications. And people would say, well, we look at credit spreads at the moment. When high yield credit, that used to be a good guide. It's not a good guide anymore. So, for example, one of the reasons which also leads me scared about underlying elements of the shadow financial system is that, I was looking at stories on Bloomberg today, and private credit has gone from sort of 800 billion in 2019 to like 1.7 trillion now. And the outstanding, whereas Bloomberg Barclays have these big indices of bonds. So it's like the US dollar high yield.
The risky deals aren't being done in high yield bond market.
No, so that index is now down to only 1.3 trillion. It's like the smallest it's been in years. So when I'm looking at market credit spreads in high yield, actually, they no longer have the same validity because it's actually a much smaller percentage of the market. And they're probably going to be the better credits as well. Or when people go bust and they default, they automatically fall out the index, and then private credit comes in, it's picking up. So there's certain measures that become like, well, yeah, I look at that and I don't want to own high yield, but actually, and I don't. But it's that the idea is that as an historic measure, it looks completely out of line when you look at sort of delinquency rates, for example. So you can go back over the decades, and delinquency rates and credit spreads go with it. Delinquency rates gone up here, credit spreads are down, and credit spreads are down here at the moment. It's like, real contradictions. But that in turn, from a valuations perspective, again, it allow people to go, well, we look relatively good value versus credit. Well, what credit? And actually, is that credit giving you an accurate implication? So ultimately, I'm not an equity man. I've always been, rates, FX primarily, and EM, and and then there's the questions about funding. So, Japanese yen it's very cheap. We all know it's cheap. I mean, just the sheer number of tourists going there tells you it's cheap.
But it's not cheap on the only one metric that really matters, which is interest rate differentials, right?
Yeah, but those interest rate differentials are narrowing quite rapidly. Okay, you still need rates to go up at the front end. But when you look at longer dated yields, so I was talking about those longer dated yields in JGBs. Well, 15-year 15 Japan or JGBs are 30 odd basis points over bunds. So I'm a Japanese investor. Why on earth do I want to own bunds or European fixed income here? Or US fixed income for that matter, when if I'm hedging on a hedge basis. I suppose the question is, when we look at Japan, when does Japan cease to become the funding currency of choice? Using CNY or CNH as a funding currency is not really practical, but is it going to be the euro? So if European rates, so we see a lot of talk about, even the hawks are talking about the possibility of 3 cuts this year. And there's a lot of other stuff talking about that. ECB's own projections, I think, came out like yesterday. We're talking about rates getting back closer to 2. So if Japan's at 1, which they should, that's where they should be. I don't think short rates at 1 and have a more flatter yield curve would be particularly disruptive. But I do feel like with euro yen above 170 and dollar yen, we can talk about they're still printing money, but actually the other thing I'm keeping a close eye on is the Bank of Japan's balance sheet. which is no longer expanding. So when they talk about their JGBs, it's merely reinvestment. It's no QE is stopped in Japan. So there's a bit of narrative out there. So they say Bank of Japan's buying bonds. When you see that headline, they're not really buying bonds. They're not a net buyer.
They're not a net buyer, yeah.
But the narrative, the popular narrative, they're still buying bonds and stuff like that. But so it's another thing I'm keeping a very close eye on, because the Bank of Japan balance sheet if it does start to come off, then at the edges, these marginal effects. So for me here, being long dollar yen is basically picking up pennies in front of a steamroller. You can get paid for it, and it might go nicely for a few days. But if you get, either, let's say, hypothetically that poor payrolls number or cracking on US data or something like that, and oppositely, Bank of Japan goes, actually, we're just going to raise short-term rates, given we've got 30-year yields at 2.25%, 40 yields at 2.5%, 10 years at 110, raising overnight rate to 50 or 75. For Japan, it would be quite significant, but in FX terms, that would have a big move. And it's those because when they're all, FX players are very much short end focused in terms of it's all about the overnight and the funding. So if the overnight shifts, then all of a sudden that's the danger.
But doesn't overnight not really change, because the changes would have to be in the market based on expectations of forward policy, and overnight rate is a few basis points.
I think one year yen OIS is around about 60 basis points at the moment. If that goes to 1%, and the overnight rates, the Bank of Japan goes right behind key, bang, here you are, 25. None of that nonsense, 10 or rubbish nonsense. And actually, we might take interest rates to 75 basis points to 1%. Then that could be at the same time you've got easing elsewhere. So that's when you get this sort of thing. So for me, I've got no particular yen trade recommendations at the moment, because it's not really. I'm much more comfortable with, the signals on CNH, and therefore rolling into that. Either not so much things like, because I ran Asia rates and FX strategy when I was at Citi. So you look at like Korean won versus yen as a very high correlation, but then you look at other, so it's things like the Aussie and the Kiwi, and they start, if China goes, they just ultimately they get spanked. I mean, they like to think of themselves as separate nations, but there's like constant use to whine by my Australian colleagues and when I worked for a large Australian bank, it's like you have to remember that the population of Australia is just that of a large city in China.
You're serious?
Oh, absolutely.
Oh wow, yeah, and a huge commodity exporter. So if China goes, the currencies go. So you're bearish on Australian dollar and the Kiwi dollar.
I think one has to be extremely careful about it. And overall, I mean, it depends what currency place you put it against. You just put it against, is it against Aussie yen, or is it something like that? Because the yen has already done so much, and this is another factor for the Chinese. They look at the yen, and they look at there's charts. You can look at JGB yields, which are going up like that. Seeing Chinese government bond yields, which are going down like that, and the yield differential is at an all-time record low, and yet CNY yen is at the highest level since 2008.
Because the yen is so weak.
Yeah. So for the Chinese to come out, well, look at the yen. Don't go ask about our currency. They've got plenty of political, arguments that you can get away with stuff.
You're a bear on the Chinese yuan, CNY, CNH, RMB, however people want to put it. It's very all similar to the Chinese currency. I gather being long the dollar and basically borrowing Chinese yuan to buy US dollar assets is a positive carry trade, because the US has higher interest rates than China.
But your funding is much harder in doing in CNH.
So what would it affect for a hedge fund, an institutional hedge fund? What would
they can do the trade. Some don't do it in options. They can do it in options. A lot of it's so much of the FX market's done in options these days.
Didn't know that. I've never traded currencies in my life.
But a huge amount of the business is done in options, so it's on strikes and all that sort of stuff. So again, I'm not an options expert. I have an idea, and then I'll go to the guy who actually knows his Vegas and his thetas and all that.
His
stuff.
Vamas.
His gammas, his, all that sort of stuff.
Yeah.
I'll go and ask the professional about what's the best way to structure that and where's the value in, is it a corp spread or whatever it is it a vol trade? But overall, and then if you translate that across, so if China does go, well, actually, are you better off doing it in like Aussie dollar or Kiwi dollar, which not so much Kiwi dollar, but let's say Aussie dollar hypothetically, because it's very widely traded, and you've got greater depth. So you use it as a proxy. What do I use as a proxy? Well, that's the way we work in sort of that sort of FX world. But what I'm trying to get across is, just finishing off, people are, I think, are too relaxed about the China impact overall. I think overall, more broadly, we are normalizing.
Yes.
After a very unnormal, that's not even a word, is it? After a very disruptive, unusual experience, which basically just threw a wrench in the engine and disrupted everything. So data spews out, it's all incoherent. All these other multiple factors like, excess monetary stimulus, excess fiscal stimulus, wars, the whole shebang. And it does feel like overall, people are getting back to normal. We're going back to work, No, you can't work from home anymore.
Hey, Patrick, where are you right now? Where am I right now? Come on.
Yeah, but I run my own business. It's a bit different. But if I was working with somebody, then or I was running inside a business. No, I won't. They go, there's a lot of effects of how do. As I told you, I'm very passionate. I'm a passionate believer in training and mentoring and bringing people on. And it was one of the area parts of my, when I worked for big banks, that gave me actually some of the greatest satisfaction. How do you expect young people to start their careers spending most of their time working at home? When you walk into an office, you're effectively as useful as a chocolate teapot.
Hey, that sounds pretty delicious to me.
You know what I mean?
Yeah.
You put anything hot in it, it just melts. It's nothing. So, all that training, that on-the-job training, that interaction, that's where you really learn your stuff when you're getting going. And, it's working from home. I suppose the best thing I read about working from home recently was if you're working from home, you're 35% more likely to be made redundant. Now, some people may think that's horrible, but if I'm running a business, no, I want bums on seats. I want you in the door. Okay, trading floors are different. They basically, as soon as they could, they were back in 5 days a week. But overall, that mentality, that being in a room, and it doesn't matter where you are, that being in a room, it's good for one. It's good for one's mental health. It's good for one's social skills, and it's good for one's learning experience.
I won't disagree with you, Patrick. I will say, for our viewers listeners who are not watching this, I am at home and you are at home. But your point is well taken. So, but Patrick, good point. A lot of the currency trading is not done on borrow yen, buy dollars. It's done on, you talk to a bank and they buy an option for you, or a brokerage, they buy an option for you. But because of the positive carry of, i.e. dollars have higher interest rates than Yuan, therefore, I'm not very good at this, so I had to think about it. But the forward rate for the dollar is lower, i.e. Chinese yuan appreciation is priced in.
Yeah, but it all works out in the maths. So it's, even when you're trading options, basically you do an option, you probably delta hedge it. So you're going to have some funding exposure. It's not just near a funding exposure.
Right. If the spot rate is 7.27 yuan per dollar, and you wanted to buy the forward rate is 7.08, so you'd be buying a collar put with that strike, with that as the case.
The 1 year forward rate would be 3% lower, but that will come up. But overall, let's keep it straight. Let's talk about vanilla. Where do we think the spot rate's going to be? So let's say dollar China goes to 750, 770. It's a nasty deflationary shock for the rest of the world. And you should get people go back. And in 2015, when they did devalue, and we go back to the start of the year, and the beginning of 2015, the Fed was thinking, we raise, because under VanEck Ad, they'd already started doing projections. They thought they were going to raise rates by about 1% over 2015. Then eventually data was a bit softer. Then China devalued initially in like the July, August of 2015. And that stopped the Fed. And eventually they hiked by 25 basis points into December of 2015. And then the following year, there was other events like Brexit and stuff like that. In 2016, they only hiked by another 25, despite having again forecast. Well, no, we're at that point. We're at a different stage of the cycle where rates are up at the highs. We're at the end of the tightening cycle, hopefully. If that's the case, well, then the logical thing is, well, actually, that's another. China is another potential downside force on global interest rates as well. And to my mind, markets have sort of got a bit about it at the moment, and they shouldn't be, because and that would feed through to global equities as well, because it means pressure on margins for many, many industries. And correspondingly, not just margins, but investment and everything based on it. So everyone's going about tech and AI and stuff like that. But hey, if we're not doing so well, we're not going to be investing so much. Just it's maybe, I'm not talking about the Great Recession. Maybe it's just going to be back to mediocre growth, more moderate inflation.
Absolutely. And the stock market could interpret that as a soft landing. Like, for example, 2015, people refer to it as a mid-cycle slowdown. There was a recession in some manufacturing cyclical industries, but the U.S. economy did not enter a recession. Likewise, I think we've had a slowdown from very high rates of growth to less high rates of growth. And the market had, as well as inflation, and inflation has fallen at the same time. So real growth has actually been positive and been getting more positive. And the stock market has interpreted that very favorably. So do you think the scenario, which it sounds like your base case of sluggish growth, but as well as falling inflation, do you think the stock market will interpret that as a soft landing, as it has over the past year and a half?
Well, because they're still talking about their earnings growth. So, for what you could find, let's not forget, everyone's going, oh, the Fed has tapered. But the reality is, they've only done it on treasuries, and there was a very practical reason for that. So there's still going to be draining liquidity over time. There's still, if the housing market activity picks up and interest rates fall and mortgage activity picks up, prepayments pick up, so therefore the mortgage portfolio goes off quicker. At the same time, they've reduced down from up to 60 billion a month to 25 billion. There's a very good reason why they chose 25. It's because later on this year, we've only got just over 25 billion maturing at some months because of the nature of this open market holdings of US treasuries.
The treasuries would have the same problem as the mortgage-backed securities had of there not being enough to meet the cap. So why not just lower the cap?
Yeah, from a practical perspective. And they only have a certain amount of bills. So, but always on the treasuries, they've always met the cap. So it's like a practical element. And they don't, and ultimately over time, as they did back in 2014, 2017, 2018, the whole intention was when they stopped doing balance sheet reduction, they kept it going with the MBS. So the whole idea was we don't implicitly feel good about having credit on our balance sheet, and we just want to have pure treasuries. They keep on failing to get back there, and they always will. But my point being is there's still reasonable amounts of QT or balance sheet reduction going on in the background, and maybe it could just be a situation where equities just go sideways and bore the hell out of everybody, which they did for certain periods of time. Good part of the mid-teens, so they were very boring. It could disappoint a little bit. Again, as I said at the end, it's not my core strength. If China does go down the route that it could, in theory, it might, then I think it's hard to think that that's good news for global equities or margin, and certainly earnings expectations.
But good for Chinese earnings expectations. So, Patrick, the current yuan to the dollar is 7.27. The forward rate is 7.08. So you're bullish on the dollar against the Chinese yuan. Which do you like more, selling a 1-year put at 708 at the money, or buying a 1-year call at the money at?
Well, everything's priced. I mean, so I tend to be either way. You're paying your option premium either way. I tend to be much more. I'm much more of a Luddite. I just kind of go in and do a spot and literally do my overnight funding. I know I'm going to pay money. There's always a cost to carry. That's what you have to pay.
Even if you borrow in a currency that's yielding lower than the currency you want to buy, because of brokerage fees.
Well, no, not just for brokerage fees. So I'm saying because basically, I can borrow a spot, but to buy dollar CNH, but the forward's still lower. So it's much of a muchness to me. There's just like people who, don't forget, there are guys out there who are the experts in this, and they're arbitraging everything away and doing these trades. A bit like, they basically, think about it as, you hear about the basis trade in terms of the treasury market. Basically, a huge amount of FX trading is a basis trade, a de facto basis trade. So there's lots of multiple millions, trillions of positions built up, but all around the arbitrage or nicking little bits out. How much is actually pure directional is debatable. I'd say a disappointing portion of FX exposure is actually directional. Most of it is vol guys and things like that. The question is, what happens when vol turns up? And that's the other interesting question, because global FX vols are very low. They've fallen quite a lot. People talk about VIX, even the interest rate volatility is also coming off. So I'm going to finish off now with, we're talking about these hypothetical questions, the whiteboard. What do you put up on the whiteboard and say things that we have to watch out for? Mm-hmm. So you go back, an extreme example would be March 2020. That's COVID, when the rates market exploded up.
Hey, Patrick, sorry to interrupt, but I've seen some incredible calls on financial media, and I'm lucky to say that I've interviewed people who have made incredible calls that have aged very well. But I'd say one of the best calls I've ever seen anyone make was by you. Unfortunately, not on this program, but it was on CNBC in January. And you were saying, I'm worried about this COVID thing. I'm not going to try and do the accent. The host, who it was a very competent and intelligent host, but she was kind of pushing back on you. She's like, COVID. I mean, come on, stocks are a buy, right, Patrick? And you were like, I don't know. Needless to say,
I said no. No. I was okay. That's an extreme example, but overall, I'm just saying, people should have to keep a close eye on liquidity. We've got all this stuff with repo. We've got all the tightening up of stuff at T+1. We've seen various issues with banks at times.
You don't think that's over? I could see a case that's over. That the interest rate debacles of last year, the banking.
Oh no, for banks, no, it's the non-banks which are the problems. This is the lending out there. So it's basically your pension fund gets hit because everyone's gone into, I want private equity, I want unlisted assets, but it's a major issue for the Financial Stability Board, and the likes of the IMF as well have written about it.
Yep.
So there's a broad, but the extent of leverage within markets. So we talk about the basis trade, and the whole US liquidity argument about what happens with things. So we go back to September 19 when we had the repo crisis, because the Fed was overly complacent about the underlying amount of liquidity that a market required to finance things. So we're dragging on now, but for example, there's a big debate about how large should Fed reserves be. Mm-hmm. And Waller comes out and says, it's at least 10% of GDP. Okay, nominal GDP. That's margin of safety or whatever.
That's pretty arbitrary, right? I mean, it's
not bad overall when you look back. When it dips below these ratios, liquidity starts to tighten.
As you know, we have a sample size of 16 years because before.
No, but the world has changed. Let's just say, I know, but in our recent history, I have not seen one central banker or regulator come out and say, actually, given the size of the marketable treasury market, which is now $27 or $28 trillion, what is the adequate level of reserves for that? Which I think is far more relevant than talking about nominal GDP, because debt as a percentage of GDP is so much greater. So we've got a greater pool of debt relative to an underlying pool of liquidity. So we look at those ratios, and then we really are starting already getting into danger territory. So it was over time as reserves fall, and there's another aspect of reserves that people don't give enough credence. And actually, the Fed has done some research on this as well. I think it was the Kansas Fed or St. Louis, and because of the rise in deposits that are checkable, instant liquidity, there's an argument that, and you look at the ratios of reserves versus instantly available liquidity at banks, you could argue that they actually argue that banks actually need to keep more reserves. And what happens is, in times like that, so even though ostensibly the pool of reserves is large, banks hoard those reserves. So they keep them on their balance sheet, and they basically go, well, actually, we're not lending our liquidity out to other people. We're just going to hoard it. So it's the liquidity debate is a big one. And that's another, again, we should really call it a day. It's the final, I'd say that's the final thing to put on your whiteboard. You just be very, very aware about liquidity, because at the time, just like I'm saying, people normalize. March 2020 was exceptional. So in bond markets, it was horrendous. You had literally things were going all over the place. Futures could be rallying or selling off, and bonds could be selling off and futures rallying. People would that's why the Fed came in and just bought 700 billion of bonds in a day. Memories fade. So that's over 4 years ago now.
Yeah.
There's lots of people who actually started work since on the street, and I didn't even know what the repo crisis was like in 2019.
Yeah, we're not old timers like me and you, Patrick, right?
So but again, if I was the chief risk officer at a place, and I hate to do that because then I'd have to be the gamekeeper, and I really love being a poacher. It's the idea of what are the risks of your book. I'm going to my portfolio manager, my traders. Do you really know what your risk in your book is? Okay, these are micro things. So we're getting very, very sort of hedgy, specific type stuff.
Yeah, and I think the risk there would not be, are you too long Delta Treasuries, are you too short Delta Treasuries? It's you're long the 5 year, you're short the 7 year future, and
where's your access? No, where's your basic funding access? And they take that way around another, to the normal world. And it's well, where's your basic funding access? Where's your 6 month costs plan, say your parachute plan?
The academic answer would be the Federal Reserve. And a lot of the major financial institutions are set up to borrow at the discount window, but it's a stigma. The practical answer is the Federal Home Loan Bank.
No, but what I'm saying is that it's still the disruption of the system. But that's all very well and good. But if you're running a fund, when you could not be running one the next day.
You're talking about for a bank or a hedge fund?
Well, a hedge fund, first of all. A hedge fund in particular.
Hedge fund.
But I'm just trying to say, take that out of the hedge fund element. I see, the sort of, what was it? Someone's promoting now. It's like the leveraged NVIDIA ETF.
Yeah.
And you just go I've seen the man, as I said, I've been in this business far too long, and I've seen the man in the street, basically, whenever the man in the street thinks something's a good idea, it's normally not. And the rich guys are already heading out the door, scurrying off to the hills.
The rich guys were doing it 2 years ago, and that was the time to do it. And by the time everyone knows about it, it's kind of over because there's no one left to join the trade. It's a sad thing to say. And, in my much less experience than you, I've also, observed that to some degree. Yeah, the NVIDIA, those ETFs, I think they kind of kill you on the volatility, because even if NVIDIA goes up, I don't want to make but if NVIDIA goes up $10 and then goes down $10, if you own NVIDIA, you'll be flat, but you could lose money on these leverage things for a reason that I don't fully understand. But you're basically short volatility. Of course, if NVIDia goes to
the people on the other side, the people who are running the ETF are making the money. So, what I'm saying is that overall, there's lots of stuff out there that just makes you feel quite uneasy at the moment. Maybe I'm just, but it's, I just think one has to stand back. I think this is, as I said at the very opening, it's trying to find a narrative. And I think we're at a point now where it is very confusing still. I would never known a time where so many people are sort of scratching their heads, really. It's often quite usual when interest rates peak. It can be extremely boring at times, so it's a lot of the stuff I've been doing this year, apart from the start of the year when I was saying to my clients, no, expectations about interest rates have gone too far.
Too many cuts being priced in.
Yeah. But then by the middle of February, I was thinking, well, that's reasonable. We've had a good enough backup in yields. And okay, yields then went up higher than I thought they would be. And I know it's basically been, I call it you have it in baseball as well. Basically, I'm batting for singles, or you'd have a batting for hits. I'm talking about a cricket analogy. We're batting for singles. We're taking a single run, you're getting a hit. And it's, we're not, you can't be going out looking for the home run. So it's much more of that currency pair looks out of line versus interest rates. Maybe I'm going to get 1% or 2% out of that. That interest rate in, let's say, the UK versus US is looking either over optimistic or excessively pessimistic given the divergences. So it's been much more of that sort of nip and tuck type of strategy. Rather than, here we go. I mean, I had a nice call in sort of beginning of May because it was like the European Economic Surprise Index was, US Economic Surprise Index. You had treasuries at like 465 and the dollar was, was strong, and they were just ignoring it. And then we had that, so we got a nice rally down at like 430, and here we are, we've backed all the way up. So, that's quite a nice little 2-week trade. But there isn't any big theme at the moment. It's not like, no, this is a major turning point. We're not at a super tanker point within markets. I think that's the thing. When you just get on, sometimes you get on themes and just be like, right, I'm going to go with this and stay with it. Okay, people in equities have gone with it and stayed with it. But we're also getting divergences now, which suggests that when you look at, what's happened to Chinese equities in the past week or 2 week and a half, or Japanese equities, that maybe the rest of the world should start paying attention to those and just got to be a little bit cautious. And on that point, I think I should shut up.
We'll leave it there. Patrick, thanks for coming on. People can find you at PPG Macro. So are you a bull? It sounds, you said you like the 2-year, but do you like it enough to be?
It's more like I'm quite happy to park my money there for now. But
on an unlevered basis. What about the long end? What about the 10-year?
Yeah, I mean, I don't dislike it.
Yeah.
But the price action's rubbish at the moment. So, come back. I've had a few days off. You come back, you look at it and you go like, oh, I'll watch the price action. I'll take it easy. I don't particularly want to sell it here. I do think, we can talk about JGBs I've been talking about JGBs for quite some time because you forget about the 10-year, but even the long end has been going up, the 30-year bonds. So I did ask about a month ago, is this going to be an anchor on global bond yields? And it has proved to be. But again, that is short-term noise. But when we look at us, we'll get the chart for it as well. But when you look on a 20-year perspective, it just looks like JGB yields are actually at last catching up with the rest of the world. So compared to where everything was in like 2006, 2007, so bond yields in the UK and the US are large in Australia. There are levels we saw pre-GFC. We're in that sort of territory. JGBs are merely playing catch up to those sorts of levels. So it's I hate it when people on Twitter, they put out a chart and you go like, okay, that's about a year. But let's just put it over the past 20 years.
Do you like being short long duration Japanese bonds and being long the cash rate in Japan?
Well, no. I mean, if I was an institutional investor, I was a pension fund manager in Japan, as I was talking about earlier on, I'd be actually looking to do a bit of liability management. We'll start to buy some of those longer-dated bonds because, even a declining population, that sort of rate of return, given the historic, I'm getting. If you presume that Japanese inflation is probably going to revert back to around zero, then locking in a 2.5% return is a prudent, sensible thing in terms of managing my liabilities on a pension fund. So there are trades and there are investments, and the two are very different. So if you're a pension fund manager, yes, you absolutely should be looking at long-dated JGBs now.
The 30 year is already at 2.2. I didn't realize. Wow, so it's higher than the US 30 year was.
The 40 year is at 2.5 or
Wow.
more. So, but they're also very liquid. So you either have to be very, very good at what you do, but they really are only for professional traders and investors. I wouldn't, not for the man in the street, but it's worth bearing in mind about these potential. So I keep on coming back to the whiteboard argument. Put up these various different ideas. They're in the background, and at some point they might become relevant. They might never happen, but it's always worth bouncing those ideas around, wargaming, for want of a better description. What do we do if this happens? What do we do if that happens? And you're prepped, and if you are, that's when you really optimize things. You get because you've already got a game plan. You're not going in blind. And a lot of the time, the daily statistics and stuff, it's just noise. So I spend probably at least half my day just reading shit, going back and forth, going, right, okay, and then trying to come up. Often I find I'm just going down an empty rabbit hole. Mm-hmm. You go, well, okay, that was quite interesting, but it's got no practical application whatsoever. But that's what you keep on doing, keep on learning. Well, the day I'm not interested in doing that is the day I know it's time for me to say adieu.
Well, with that, Patrick, adieu.
Adieu. Merci beaucoup.
Thanks for watching. Remember to check out vaneck.com/MOATFG to learn more about the VanEck Morningstar Wide Moat ETF, ticker MOAT. Lastly, Forward Guidance is available not just on YouTube, but on all podcast apps, and a video version is available on Spotify and Twitter, where I post interviews regularly. Thanks again. Until next time.